Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us today on a Friday. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Stats Canada says retail sales rose 1.1% in January compared to the month before, with sales at motor vehicle and parts dealers leading the gains. The strength was broad-based with increases in all provinces, including a nearly 1% rise in Ontario. Looking ahead, an early estimate points to a 0.9% gain in February, suggesting consumer spending is holding up despite economic uncertainty. Iran is pressing ahead with attacks on Gulf Arab states, even after Israel signaled it would stop targeting the Islamic Republic's energy infrastructure. The war has killed more than 4,200 people, most of them in Iran, but across the region as well. It has brought shipping through the Strait of Hormuz to a near standstill. Iran's attacks on critical energy sites have eased from a peak earlier this week, yet crude prices maintained their rise after closing yesterday at the highest since mid-2022. The government of Ontario is moving to protect ticket buyers from professional resellers and unfair prices. The Ford government is proposing changes to the Ticket Sales Act, which will cap ticket resale prices. The amendments will be introduced in the coming days and, if passed, would make it illegal to resell tickets for concerts, sports, and other live events in Ontario for more than their original cost. The changes would address long-standing concerns about inflated resale ticket prices. And taking a look at the markets, that little blip at the start of the week has been forgotten already. Another down day across the board. The TSX materials taking the biggest hit. It's down about 18% for the year so far. And overall, the TSX off by 1.1%. And south of the border, not much better. Everybody down there. You can see the Nasdaq's off by nearly 1.25%, Dow by 0.6 roughly, and the S&P 500 by 0.87. Well, with the conflict in Iran sending oil prices higher and adding new uncertainty to the outlook for the markets, investors are looking for direction. Our next guest has some ideas on how to navigate this environment. Let's get more from Chris Curlow, Senior Portfolio Manager, Investment Advisor at Canaccord Genuity. Chris, thanks very much for joining us. And you've got a map to get through all this, do you? Holy cow, what a challenging time.
Yeah, quite a lot to navigate. A little bit different setup than what we saw in the weakness at the start of 2025. The economy's in a bit better footing. We're starting to see some of the tax bills support the U.S. consumer, and earnings growth continues to tick up. So we think that this pullback is starting to get a little bit long in the tooth in terms of both duration and size. Over half the companies in the S&P 500 are down over 50% now. So starting to see some opportunities out there.
Sorry, half of them are down 50%?
As of yesterday, it was in the 40s, so I'm taking a guess today we're probably over half.
Holy cow. So everybody is feeling the effects. But for the most part, the numbers have been good, right, for earnings and everything?
Yeah, exactly. So, that's one of the interesting things happening right now is, we look at different factors, and positive earnings revisions has been one of the worst factors so far this year. It's unsustainable. I mean, all things held equal, rising earnings expectations is going to rise stock prices. So we're looking for names in that space that have positive earnings revisions and adding those selectively to our portfolios.
All right, and you've got a few here. We've got a nice list here we can take a look at. Let's start off with the CBOE. I want to say CBO, but CBOE.
Yeah, CBOE.
We're going to call it CBO now. I'm starting a new trend. Global markets.
Yeah, so they're in an oligopoly in the markets business. Basically, they're like a volatility toll road. When volatility spikes, we get paid. It's a good ballast to the portfolio, so we've trimmed a little bit from that name to be able to allocate to other, more beaten up opportunities in our portfolio that we think are down more than they probably should be. So that was one we took profits from. Cheniere Energy, LNG, the largest liquefied natural gas exporter of the United States, up huge here recently. We're long-term holders of that, recently upgraded to investment-grade credit. But interestingly, 95% of their contracts are fixed pay. So despite the fact that they provide Asia and Europe ton of liquefied natural gas, the benefit isn't going to be quite as much as maybe the stock price here is reflecting. So just taking some profits on that one.
And with the CBOE, any other reasons other than just a little profit taking from it?
No, I mean, it's one of the ones that's been up here, right? They are market leaders in the zero-day to expiration options play. Volume picks up in trading volume. They do quite well, but it tends to be, we think it's going to be transient. We don't think that this is going to be long-lasting unless this goes a little bit longer. Obviously, the straits are the lifeline of a lot of the oil trade, so it's going to take long. It's not just going to restart the day this all winds down. So, but we still like it, still own it, just taking some profits.
And with Cheniere, I mean, LNG, isn't that kind of a place where people are going to be taking a look at?
Yeah, I mean, they just had the chart up there. You can see those type of spikes. We just are, sellers when you have that type of parabolic movement on kind of any name. We're still long, but probably have taken the position back a little bit below a normal size weight.
Okay, let's move on. And nutrient fertilizers are taking a bit of a hit right now, aren't they? They kind of surge, but they're facing an uncertain future.
Yeah, uncertain future, but I think that the misbalance in the market with about 30% of the world's urea goes through the Straits of Hormuz, and so that's kind of, obviously locked up right now. So again, Nutrien had a bit of an early rally. We took some profits there. It's a name we've been in for a little while, so we got out on that spike. It's coming back a little bit here, just with the broader market.
All right, and Sun Life Schroeder emerging markets. Let's talk a little bit about that.
Yeah, sure. So for the past couple of years, we've been big proponents on the disconnect between the valuations internationally and the United States. That gap continues to be present, but that earnings growth that we talked about a little bit earlier is even more pronounced in international developed, but even more so in emerging markets. So obviously, Asia, the emerging markets that trade directly in that region with the oil crisis that's taking place have been impacted. Mm-hmm. So we've added to our emerging markets exposure. We actually like LATAM even better than Asia at the moment, but Schroeder is best in class. They've been doing it a long time. We're not going to say we're the best EM stock pickers, so we just pay our friends at Sun Life a little management fee to do that for us.
And with the emerging markets and LATAMs, what gives you the optimism down there?
Good government change in Latin America in particular. We've seen regime change in obviously Venezuela, Argentina, Bolivia. Most moving more to pro-business. They actually have the ability to continue bringing rates down. We've obviously seen more of a pause here in North America. So we think that should be a catalyst for those markets through the duration of 2026.
And with Asia, not worry about that dragging everything else down?
Yeah,
when it comes to the emerging markets at least?
Yeah, like I said, we think that this should be transient. I think we'll find some resolution here. It's the eye of the storm, so but there's great companies there, and we let the active management do that selection for us and focus on the North American space where we think we have a competitive advantage.
All right, some stock picks here. Next Gen Energy, you're buying, selling Uranium Energy Corp.
Yeah, so Next Gen, I think, is maybe one of my best ideas right now. You could see the need for diversified energy exposure. Uranium, we believe, is going to be a key pillar in the future for both data center and just like the supply-demand mismatch from this data center build-out that takes place. Green energy. Next Gen has an amazing project, Rook, in Saskatchewan, world-class, going to produce about 30 million pounds a year. They only have 2 million of those contracted for the next 5 years. So I think that's a catalyst for the remainder of 2026. You add to that, it's like a world-class project with low-cost opportunity. And so we just moved from UEC, which we owe a ton to. It was probably almost a three-bagger for us since adding it last summer. So we're just moving into something that this project just got approved and is going to go into construction this summer. So really excited about the prospects there. And I think it's a great way for investors to get exposure to a fantastic long-term trend in clean energy.
And you're selling Uranium Energy?
Yeah, I mean, for no other reason than just we like kind of the catalyst driven here. I wish I could own both of them, but we have a pretty concentrated portfolio. And it probably has a little bit more beta sensitivity to the price. And I think these guys moving into a producing mine by 2030 and the catalyst with the contracting of those pounds up through the rest of this year. I think we see a ton of upside from a stock that's trading under 10 billion Canadian, 7 billion US. It's going to be a lot more than that in the future.
Okay, we got to wrap it up there. I'm just going to list off a couple of the other ones you want. Buy Union Pacific. You want to add to Palo Alto Networks and trim Meta Platforms are the other three. But thanks very much, Chris, for joining us. We appreciate it. Have a great weekend.
Thanks.
And try and stay dry today. It's raining like crazy here. That was Chris Carlo, Senior Portfolio Manager, Investment Advisor at Canaccord Genuity. Up next, we'll break down the recent numbers for Stats Canada's January retail data. That's in a moment. Stats Canada today releasing the latest Canadian retail numbers for January. Retail sales increased 1.1% to $70.7 billion. Sales were up in 6 of 9 subsectors, led by increases in motor vehicle and parts dealers. Core retail sales, which exclude gasoline stations and fuel vendors and motor vehicle and parts dealers, were up 0.9%. In volume terms, retail sales were up 1% in January. For a deeper analysis on this, we were joined earlier by Simon Gaudreau, the Chief Economist, VP of Research at CFIB.
It's in line with what analysts were expecting, perhaps a bit lower. I think flash estimates were around 1.5% for January. And this rebound was made possible basically with the consumers catching up with some of the holiday discounting that happened around December. This is a welcome rebound, although perhaps a bit slightly lower than expectations.
Is that worrisome that it was lower? It's off by 0.4 points with what analysts were expecting. Is that worrisome or no?
It is. I wouldn't say it's worrisome. It's showing a consistent weakness in the economy. This is something that's reflected also in other indicators. For example, for us at CFIB, our monthly business barometer is tracking weak demand with retailers. It's been ongoing for a relatively long period of time. We've tracked lower demand during all of 2025 and for the first 3 months of 2026 as well. We just released yesterday our March numbers, and this week demand seems to be quite sticky. So the numbers that StatCan released this morning are unsurprising, although there is growth. So that's the silver lining. But it definitely does reflect an economy that is not as strong as it could be.
Simon, what are your thoughts on when inflation shows up from the oil spike, and how sticky do you think that's going to be in terms of how it persists? Any thoughts on that?
Well, with the inflation situation, of course, there's a very high level of uncertainty. We're not sure exactly when this situation is going to be resolved. So as long as this remains, it will be very hard to sort of try to chart a course for a path for inflation in the next few months. Definitely, it has started to hit consumers and the economy. We're all seeing prices at the pump going up, and they keep going up as long as the situation is unresolved. For businesses, it also translates into higher input costs and raw material costs as the effects of this oil price shock makes its way through the supply chain.
Go ahead, if you get a follow-up question.
Yeah, so just a follow-up question. So you're looking historically, when you've seen a quick run-up in energy, and I think the last time we saw was 2021, how long does it take to sort of work through the system when the prices come back down? What's the lag? We're looking about 3 to 6 months, or does it take perhaps a little stickier and takes a little longer to work through?
Well, I think, again, it all depends how the situation unfolds and how fast it is being resolved. I think for business owners, as they look at the current situation, they see the prices increase, and they will take measures also to mitigate those price hikes. So in terms of duration for how long this is going to take to process all of this, again, relatively hard at the moment to estimate.
Thank you.
And just looking provincially, all the provinces saw increases in sales. Where do you go with that?
Well, I think this reflects the fact that the situation that we're seeing, the shocks that we're seeing, we have to remember that what we're looking at are January data points. So back at that time, the trade war, the Iran situation had not started, and the impacts that were taking place, the macroeconomic impacts were kind of broad, and so impacting all economies in the same fashion to a certain extent. So that's why we're seeing probably all provinces showing similar patterns. Now, the story would be different if we were to take the temperature now. Of course, some provinces are more or less impacted by the oil prices because of their situation regarding production. We have provinces that will ultimately benefit from that, as interesting as it may sound, but it's definitely going to hit consumers at the same time. For retail sales, that's the important factor to consider, and we can expect probably if this situation again continues to see some lower economic indicators going forward, including perhaps retail sales.
Simon, one other question. What raw materials besides energy are you sort of thinking through that have big impacts on the inflation side?
Yeah, so when it comes to raw materials, the way it could impact the supply chain is through anything that has an important energy component, whether it's oil or natural gas, because that's also a very important commodity here that's being impacted by the current situation. So you can think of things like aluminum, for example, that could be impacted. Prices for aluminum could be impacted by the current situation, and of course, we do have a lot of businesses that rely on that type of material for their products and their operations. You could have all other sorts of commodities that will have a major energy component attached to their production, and that again will make its way through the supply chain gradually and will impact the costs that suppliers and manufacturers charge or pay.
And that was Simon Gaudreau, a chief economist and VP of research at CFIB, with our featured guest, Darren Sissons, partner and portfolio manager at Campbell Lee Ross Investment Management. That was on the streets. Coming up, today's market drivers with Bloomberg's Matthew Griffin. Check on some movers south of the border, and for that we are joined by Bloomberg Equities reporter Matthew Griffin. Matthew, always a pleasure, sir. How are you?
I'm doing well. How are you?
I'm not too bad. How's Mosaic doing? Let's talk about that off the top. They're struggling a little.
Yes, Mosaic selling off today, not doing great. The fertilizer company's stock was cut to a hold equivalent rating at Bank of America. And, you were just talking before the break about all of these parts of the economy, these commodities that have an energy component in them. Well, fertilizers is one of them. And so what Bank of America says is that the cost of Mosaic's raw materials is going up during the war. That's putting a squeeze on profits. What I think is so interesting is the way the war is creating winners and losers, even in an industry with, a relatively small number of large publicly traded companies. You look at CF Industries. On paper, they're a peer of Mosaic, but they actually keep hitting record highs during the conflict because they are a major producer of ammonia. That's seen its prices soar. Mosaic, though, a lot of their operations sit a little further down the supply chain. They buy a lot of ammonia. They buy a lot of sulfur, which is also produced alongside petroleum products. And that has seen a real divergence in the stocks. CF up almost 30% this month. Mosaic now extending declines today to about 12% since the war broke out.
All right, so I was just looking. CF is up today, but Mizuho cut it to underperform from neutral. Just trying to read this quickly as we go there. So everybody's got some challenges going on right now. Next up, let's take a look at York Space and a good solid outlook.
Yes, so York Space, another company that has had some challenges lately. The shares have slid since their initial public offering, but we're seeing a bit of a turnaround today. The company gave a profit outlook that JP Morgan described as solid when they reported earnings for the first time since they went public in January. They also said they expect to be profitable this year on a basis, excluding interest, taxes, items like that. And so you also had some commentary from the company that JP Morgan was positive on. They say the big question for this company has been, can they build out their backlog, keep winning business? And they say the tone from management was positive on that, both for the commercial side and the government side. That being said, shares still down around 36% since this company went public. They make satellites for both defense and commercial purposes, expected to benefit from things like the Golden Dome missile defense program, but it really remains a show me story on Wall Street there.
All right. And Gemini Space, which has nothing to do with space, what's going on with them?
Yes, Gemini now reversing a pre-market gain, falling today and extending declines to about 80% since the company went public in September. There were some puts and takes in the crypto exchanges report, revenue beat estimates, profit missed. But what analysts say is at the end of the day, there just isn't support for this stock's valuation. They aren't profitable, but they still trade at a premium to peers on a gross profit basis. That's what Truist points out. And revenue numbers are probably going to have to move lower based on some of the commentary out of the company. So despite some of those maybe positive elements of the report, just not enough to turn things around because the crypto world has changed since this company went public. Bitcoin sliding this year, really trading sideways since the war broke out. And the stock cannot catch a break no matter how many jobs the company cuts, no matter how much they scale back their operations to try to make the company more efficient.
Yeah, the crypto is really trying to figure out where it fits in with everything that's unfolding right now, isn't it?
Yes, you have this constant conversation about whether crypto is a risk asset or a hedge. It has tended to behave more like a risk asset. You saw it plunge during the tariff sell-off last spring, for example, but investors really can't seem to make up their minds during this latest period of market volatility. Again, Bitcoin has not been hit as hard as some other assets during the war, but also has not staged a rebound from the sell-off it's seen. We're just waiting to see if there are any buyers left in this market.
All right, we'll have to wrap it up there, but Matthew, have yourself a great weekend, sir.
You as well.
Bloomberg's Matthew Griffin. When we come back, shares of FedEx are trending higher after a third quarter beat. We'll break it down for you after this. Retail sales across the country saw an increase in January. Data from StatsCan showing receipts rose 1.1% compared to the month before, led by higher sales at motor vehicle and parts dealers. Sales at sporting goods and general merchandise retailers also saw an increase. On the downside, food and beverage retailers posted the largest decline. In a flash estimate for February, StatsCan predicts sales will rise 0.9%. Shares of Supermicro are sinking today. They're off more than 27% after 3 people linked with the company, including its co-founder, were charged with helping to smuggle billions of dollars worth of AI technology to China. A new lawsuit alleges that Supermicro servers were used to illegally transport advanced NVIDIA chips to Beijing. The U.S. imposed chip export controls in 2022 to ensure China's military would not benefit from its technology and to slow the development of China's AI efforts. Shares of Meta are seeing some pressure. They're off about 2% right now in a reverse move. The tech giant is keeping its Horizon Worlds VR platform alive after backlash from users. The platform was set to be shut down on its Quest headsets, but Meta now says existing games will remain available for the foreseeable future. It's a partial retreat for CEO Mark Zuckerberg, who have been pushing for the metaverse as the company shifts focus toward mobile, where most user activity is already happening. And taking a look at the markets, another down day. We started the week in the green, but we are going to end in the red. TSX off by almost 1.2% right now. Materials driving that down. And south of the border, not much better. Yeah, S&P 500 off by 0.88, Dow by 0.6, and the Nasdaq, take a look at that, off by more than 1.25. One positive south of the border, FedEx beat expectations, posting strong fiscal third quarter results and raising its guidance for 2026. The company says its freight business is on track to be spun off on June 1st. Let's find out more about this from Justin Elliott, portfolio manager at Caldwell Asset Management. Justin, thanks very much for joining us.
Thanks for having me on.
I imagine they've been rewriting that guidance a little bit over the last few weeks with everything that's unfolding, but still a lot of optimism. What did you like the most out of these numbers?
Yeah, so interestingly enough, they build in fuel surcharges to a lot of their pricing contracts. So they really didn't see that much disruption from higher fuel prices, and they don't think that's going to impact the coming quarter as well. Middle East also a very small percentage of their overall revenue. But for the current quarter, we really like the results here, and it builds on recent momentum they've had over the last couple of quarters. They beat on the bottom line by nearly 30%. And what we're seeing basically is this is a lot of company-specific drivers are expanding their profitability and expanding their margins. So they've consolidated their networks to make them more efficient and kind of reduced redundancies that used to exist. As you spoke to, sort of the freight business, which has been a little bit softer and sees more competitive pricing pressures, is going to be spun off. So that sort of unlocks value in the core of the Federal Express business. And lastly, they've just, on their cost-saving targets, really come in ahead of schedule, and there could be potential upside to the longer-term targets they've laid out in the past. So we think overall it was a pretty great quarter. I think it's great to see when a company is having success with their turnaround and the stock price reflects that. I think that's what we've seen in the last little while. And it was a solid quarter for sure.
And their EPS was way up and 16% year over year increase, but also they had that one-time tax benefit.
Yeah, that's true. We typically kind of disregard those sort of one-off items. Again, looking back to really the core profitability, so reducing the redundancies in their core express network. A lot of that has also been driven by moving away from lower value sort of e-commerce and consumer goods packages more to the business to business side. So on the healthcare front, for example, where you often have tight temperature controls for moving pharmaceuticals, they've been winning business in that space. On the automotive side as well, for example, moving parts for both EVs and internal combustion engine vehicles. These tend to be customers that are less price sensitive and care more about sort of quality and on-time reliability. So as that mix has shifted to more profitable business, that's really been the core driver of that profitability improvement and the margin expansion that we've seen.
Now, you said they factored in energy increases. Any other potential headwinds that you see for them?
So when we look at the valuation of the shares right now, it is at the upper end of its historical range over the last 5, even 10 years or so. Just given everything that's going on in the Middle East, we're somewhat cautious here, especially given the run into earnings as well. For any potential slowdown in sort of industrial production, manufacturing, both in the US and globally, especially on the automotive side, like I just mentioned. So we're a little bit cautious on the macro, but in terms of company specific, idiosyncratic drivers and things that are within the company's control, we are bullish on that. So it's more so just caution around the macro and whether that would slow down, some of the recovery we've seen in things like the PMIs, industrial production, stuff like that.
All right, let's get to a couple of stocks you're liking right now. Amphenol?
Yeah, Amphenol. So they're basically one of the leading global providers of interconnect and sensor technologies. And the way to think of their products is basically connecting sort of mechanical and electrical processes together within a product. And so why we really like this company is they have very diversified end markets, and they've got great exposure to a lot of these longer term, strong secular drivers. So things like the data center, right, where you see more need to connect very large clusters of servers. Amphenol is front and center there, and they're winning more business, more content on these newer generation servers. For aerospace and defense, as things get more technologically advanced, they're seeing a big uptick in their business as well. Another thing we really like about the company is just their decentralized business model has shown that over time, they're really adept at navigating tricky market environments. They've got their managers on the ground that really know what's going on and can sort of right-size the business as demand changes in real time. And so that's kept a very tight range on their margins over time. And we think, we like that as a sort of area of stability when we think about the more choppiness we've seen in the markets over the last little while.
All right. And the other one is, I love this, Price Smart. It's the Costco of the Caribbean.
Yeah, exactly. Not a very well-known name here in North America, but oftentimes Price Smart is basically the only membership club model that exists in the Caribbean and South and Central America where they operate today. And so you have a very long store growth runway for the markets that they are already in. And then you have the potential to enter new markets. So Chile is a market that they've entered recently. One of the more stable markets down south, sort of higher income consumer. But from a company specific standpoint, what we like is they are really upgrading their tech infrastructure. And so that's helping basically communicate better with customers, helping drive that membership income upsell, basically going from the regular membership like we have in Canada to sort of that executive membership. And they find that basically that upsell just drops straight to the bottom line. There's nothing really required to sort of serve that upsell. And so we see an improvement in profitability. We see a very nice store growth outlook to the stock. And when you think of a Price Smart versus a Costco, this can be had for 25 times forward earnings versus a Costco at 40 plus. And so you're getting kind of similar metrics, but at a much cheaper valuation. So we like the company.
Okay, we have to wrap it up there. But Justin, thanks very much for joining us. Have a great weekend.
Thank you for having me.
Justin Elliott is portfolio manager at Caldwell Asset Management. Coming up, Supermicro is in the spotlight today as the stock hit its largest one-day loss after the company co-founder allegedly smuggled $2.5 billion worth of NVIDIA-powered AI chips to China. We have more on this after the break. Shares of Supermicro are under super pressure today after co-founder and senior vice president Wally Liao, along with two associates, were charged in New York with allegedly smuggling about $2.5 billion worth of advanced AI servers that had high-end NVIDIA chips to China. The company says the co-founder has been placed on leave and a contractor linked to the scheme has been terminated. Let's bring in Mark Newman, managing director and senior analyst at Bernstein. Mark, thanks very much for joining us right now. Quite the case. I mean, this really gets into espionage, doesn't it, really?
Yeah, I mean, it's these three people, two employees, one of them co-founder, as you mentioned, the other is a contractor. Uh, they're accused of essentially illegally diverting NVIDIA GPUs to China. And if you go through the indictment, which was just unsealed yesterday evening by US government, it really has quite a lot of details about what they did, including building fake servers to show in this company in Southeast Asia to kind of fool the auditors. And so they went to a lot of lengths to do this.
And so what are some of the charges they're facing? And the company's not named in this, but obviously it's paying the price for it.
Yeah, the company is not named. It's important to mention that. And in fact, Supermicro responded pretty much immediately with a statement. We put a link on that on our note to investors this morning, saying that, saying exactly that these are three individuals. The company's not named, as you mentioned. They've all the contract relationship has been terminated, and the two employees have been put on leave. I don't know the details about what the charges will be, if they'll be let off on bail, but they were two of the three were arrested yesterday. And I think this may go to trial, or it may get settled out of court. We don't know the next steps. But in terms of impact to Supermicro, as you can see in the share prices, I think what's happening right now is investors are really questioning, is this another isolated case of rogue employees doing something bad, or is this just another, more evidence of systemic compliance gaps inside Supermicro? They've had accounting fraud allegations in the past as well. In fact, one of the co-founder, Wally Liao, who was arrested yesterday and is in this case, was also involved in the accounting fraud allegations before. And so, I think that's the worry here. Is this systemic? Is this going to keep recurring? Or is this a one-off? And I think that's why the stock is down so much today.
And going back to that one from 2018 when he resigned after that scandal and then rehired, why would a company rehire somebody who had been in the middle of something like that?
Well, that's exactly my question. It does seem quite spectacular that the same person who resigned, as you said, because of the accounting fraud in 2018, he rejoined around 2022 and then was promoted back to the board of directors in 2023. So he's a very senior person brought back after those accounting fraud issues. He's also mentioned in the new accounting fraud issues, which were from 2024 as well. And so it seems to be a recurring theme, unfortunately. So yeah, it's a good question. It's a kind of fool me once, fool me twice type of thing, I think. Yeah.
That's George Bush, right? Shame on you, me, somebody. Okay, so how does the company bounce back from this? Can it bounce back from this?
It's a good question. I mean, we just have to wait to see how things settle out here. I think what we would worry about is if NVIDIA feels the need to distance themselves further from Supermicro because of this. And also not just NVIDIA, but I should say customers. Customers at Supermicro, are they going to want to distance themselves from Supermicro, and that moves business away? And I think this is why Dell stock is up today, because Dell is the obvious beneficiary from this, because they are the leader in AI servers. Supermicro is the close number two. This is AI server OEMs. And so any share loss from Supermicro, naturally you would assume most of that would go to Dell.
And how intertwined are NVIDIA and Supermicro? Would it be easy for NVIDIA to pull back?
I think it would be doable because they can just work more through Dell. Possibly they could, if HPE, because HPE has been playing a very, very small role in AI servers, have practically exited. Perhaps they want to get back into this. That could be an opportunity for them too. It would be huge volumes though, because we're already talking about Dell guiding to $50 billion AI servers this current fiscal year. They got one quarter orders, $37 billion. And so these are quite huge numbers. I think that could be possible to de-emphasize Supermicro and divert more to Dell and HPE. But it's not something that is that easily done. These are quite large volumes we're talking about.
Okay, we have to wrap it up there, Mark, but thanks very much for joining us.
Absolutely.
Mark Newman is Managing Director and Senior Analyst at Bernstein. Coming up, cybersecurity has been seeing a massive sell-off, but is it an overreaction? We'll get some thoughts on that with our next guest, Dan Ives, after the break.
Lured by lies, trapping Canadians.
She's a 19-year-old girl.
W5 uncovers a crime syndicate, hunting for traffickers.
They just asked me to find people for them?
Watch W5, Saturday at 7 on CTV and Crave.
Cybersecurity stocks have been facing a massive sell-off with fears around AI disrupting the cyber landscape. But our next guest says this will prove to be an overreaction as the demand environment plays out. Here to give us his in-depth analysis is Dan Ives, Global Head of Tech Research, Managing Director, and Senior Equity Analyst at Wedbush Securities. Dan, thanks very much for joining us.
Great to be here.
Okay, so you think this is a bit of an overreaction, or maybe a lot of an overreaction. What makes you think that?
I think it's the most disconnected tech trade that I've seen going back to the late 90s. But because the hearts and lungs of protecting AI use cases and workloads are going to be cybersecurity companies. The market opportunity is going to be tremendously bigger. They are not going to get disintermediated by Anthropic, OpenAI, and others. And that's why I continue to believe this is an AI ghost trade that I believe, we're really the winners. If you own them, these will be the opportunities.
And who stands to be some of the winners in this when it comes to cybersecurity?
Well, I think front and center is CrowdStrike. Especially when it comes to their AI portfolio. Next week at RSA conference, I'll be, I think on full display. Then you look at Palo Alto Network, Zscaler, and Checkpoint. I mean, those are just four of them. Look, I think when you think it's software and all the sell-offs that we've seen, I think the most disconnected and I think the most oversold area relative to fundamentals is cybersecurity.
And I mean, we're just seeing there were reports today that Iranian hackers had got into a key Israeli former Mossad member, and we've heard other stories of that happening right now. Do you see AI being, how do you see AI working in with these cybersecurity companies and them taking advantage of it?
Yeah, look, it's a great question. I mean, given this, geopolitical environment, cybersecurity is going to play a major role on the defensive and offensive. But I think it speaks especially in when you look at U.S. companies, they're going to need to protect themselves. Government's going to need to protect themselves, which is just more money for cybersecurity. Look, it's 5% of IT budgets in terms of cybersecurity. But when it comes to AI, this is strategically, I think it could double as a percent. And even though these are white knuckle moments, and right now this is a very nervous period for tech, you got to be able to look sort of through the turbulence and who are the ones that are going to benefit, whether it's in this environment or other because of the AI revolution.
Do you see companies wanting to double, though, from 5% their spending?
I think that's what we're going to see next week at RSA Security. We'll be their biggest cybersecurity conference in the world. Budgets are increasing significantly. Stocks have sold off almost, really a do not enter zone in terms of as a sector. I think that's where the disconnect is. You're going to see more and more spending on these strategic projects. And also, you cannot go strategically down the AI path without cybersecurity. And it's not going to be Anthropic. It's not going to be OpenAI. That's why right now there's a lot of AI alarmicism going on. And I think cybersecurity right now is way, way oversold.
And I mean, the short term, but do you see that going long term as well, that AI can't replace it?
Look, I think it comes down to the stacks, the install base, the data. That's the advantage that these cybersecurity companies have. On the edges, could LLMs from Anthropic and some of these other models, could they impact it? Yeah. But that would be for the pure play vendors that would get maybe a little bit more disintermediated. When you think about the full stack, the end-to-end plays, the Palo Altos, the Zscalers, the checkpoints, of course, CrowdStrike, they're going to be stronger. I mean, these companies are going to have bigger market opportunities over the coming years. Look, right now, New York City cab drivers bearish in tech, and this is the environment.
And you mentioned about CrowdStrike, and talk a little bit about more Palo Alto, Checkpoint, and Zscalers. What do you think their strengths are that will drive them through over the next little while?
Yeah, Palo Alto, Nikesh CEO, I think one of the best understandings in terms of cybersecurity and where everything's going. They did a CyberArk acquisition that I think probably was the best pure play AI cyber technology out there. And I think this is, from an end-to-end, probably going to be the best player out there. And then you look at Zscaler on endpoints, more and more endpoints are going to be threatened. There's going to be more and more surface area to cover. That's where a Zscaler plays. That's where a Checkpoint plays. Names like Rubrix and others. I also think there's going to be a massive wave of acquisitions in cybersecurity, given the sell-offs we've seen.
All right, Dan, we've got to wrap it up there, but thanks as always for joining us.
Thank you.
All right, Dan Ives, Global Head of Tech Research, Managing Director and Senior Equity Analyst at Wedbush Securities. Market Call is coming up next, and today on the show we have Greg Newman. He's Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia McLeod. He'll be taking your questions on North American equities. And that is it for Morning Markets for this Friday. We will see you back here on Monday. Have yourself a great weekend.